where they have given us something very easy. Problem with us students here, whenever it comes to revision, you'll get most of us in this case here revising very technical things. And then we leave out something that is quite useful like this. They have given us here returns, 10, 12. They have given us here the standard deviations. They have given us here what here? The weights. And then they have given us covariance between 1 and 2. So ladies and gentlemen, they expect us to provide them with, number one, they expected us to give them expected returns of a portfolio. Expected returns of a portfolio. Is there anybody who can do that for me? Who can do this for me? Expected return of a portfolio. I would want to do this before I do the past paper question, pilot paper question. Pilot paper question. Before I do the pilot paper question, can somebody give me the expected return of the portfolio? A portfolio is a combination. So when they tell us to give them expected return of a portfolio, they want us to combine the returns of the two securities. So then in this case here, what I'll do, I'll come and say here, we have here returns 1 plus returns what here, somebody? Returns 2. But thank you very much, LM. But now remember here, we have the weights. So in this case, I'll come and talk of weight 1, return 1, plus weight 2, return 2. If I'm given expected, I would have put here expected returns. So basically here, what I'm doing is to take the weights versus what here, the returns. So expected return of the portfolio here will be 0.2 times return 1, which is 10%, plus weight 2, which is 0.8, times return 2, which is 12%. Could you kindly give me this figure? 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 So DJC anasema ni 11.6%, 11.6%, 11.6%, 11.6%. And then now, ladies and gentlemen, we shall be able to go straight away to the second concept of standard deviation of the portfolio. Standard deviation of the portfolio. What we have here are standard deviations of the individual securities. So what of this situation when they want us to give them the standard deviation of the portfolio? Is there somebody who can be remembering the formula of getting standard deviation of a portfolio? Of getting standard deviation of a portfolio before I tell you something very nice? Standard deviation of a portfolio before I tell you something very nice? Is there somebody who remembers the formula? The big formula, like what Oscar is telling me, the big formula. The big formula. Thank you very much, Oscar. But are you able to remember it? Are you able to remember, Oscar, the big formula? Sorry, I forgot to tell you that the core variance between 1 and 2, the core variance between 1 and 2, I ought to have given you a figure. The core variance between 1 and 2 is 0.35. 0.35. So this big formula, I know to get the standard deviation of a portfolio, there is a big square root somewhere. There's a big square root somewhere. There is a big square root somewhere. There is a big square root somewhere. There is a big square root somewhere. Okay. Okay. So can somebody remind us very fast? Is there anybody who has really written the formula? Can somebody remind us? Is there anybody who has written the formula? Apart from Oscar, who has said the big formula. Big formula. So, ladies and gentlemen, the big formula here is, remember, it is standard deviation of the portfolio. So standard deviation of the portfolio, I'm combining the two standard deviations. How am I combining this? I'll take weight 1, standard deviation 1, plus weight 2, standard deviation 2, like that. But now remember that these ones here must be squared, all of them. Must be squared, all of them, right? So from there, we have here plus, twice, covariance 1, 2, and then of course you attach the weights. You attach the weights. You attach the weights, like that. Is there anybody who was able to remember this formula? Is there anybody who was able to remember this formula? Anybody who was able to remember this formula? Dixon says yes. 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 Thank you very much. So thank you very much. So the weights here are here. The weights are here. So weight 1, we have 0.2 times standard deviation 1. Standard deviation 1 is 5. Plus 0.8 times standard deviation 2 here, which is 7. It's always important for you to leave out the percentages, even in the returns. Actually, these percentages in portfolio management, you leave them out. Leave them out. So 0.2 squared times 5 squared plus 0.8 squared times 7 squared plus twice the covariance between 1 and 2, which will be 0.35 times weight 1 times weight 1 times weight 1. Weight 1 is here, which is 0.2 times weight 2, which is 0. What here, somebody? 0.8. So by the stroke of a pen or a calculator, is there somebody who can give us, you start with what we have under the square root. So you'll take 0.2 squared times 5 squared plus 0.8 squared times 7 squared plus 2 times this times dot, and then you say equals. After you say equals, please give me the square root. 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 What do we have? Somebody as the standard deviation of the portfolio. So Dixon and Embeni 5.7%, 5.7%, 5.7%, 5.7%. Then, ladies and gentlemen, could you kindly go ahead and give me the coefficient of variation? Please go ahead and give me the coefficient of variation. Is there anybody who remembers the formula of coefficient of variation? This is something I'll never forget. It's something I will never forget, because I know that whenever they talk of coefficient of variation, I always think of sex in percentage. You say sex in percentage, yes, sex in percentage. The sex that I'm talking about is the one of gender, male, female, right? So in short, ladies and gentlemen, my CV here will be equal to the standard deviation. I know the formula is like this, the symbol, standard deviation all over the expected return now times 100, times 100. So please remember that they want us, ladies and gentlemen, to give them the CV of the portfolio. They want us to give them the CV of the portfolio. CV of the portfolio. CV of the portfolio. I'm so sorry. I think there is a confusion somewhere. There is confusion somewhere. There is confusion somewhere. It's like there are students who are left out or something. It's like there are students who are left out. I'm told there are students who are left out. Okay. Yeah, so I'll be forced to do like a recap. Don't worry, I'll be forced to do like a recap. But before I do that, kindly, they want us to give them here the CV of the portfolio. So then the CV of the portfolio will be equal to what? Yeah, the standard deviation of the portfolio, all over expected return of the portfolio, all over expected return of the portfolio. I'll start, but just let me finish this very fast. Standard deviation of the portfolio all over expected return of the portfolio. So do we have standard deviation of the portfolio? Is there somebody who remembers the standard deviation of the portfolio? You guys gave me 5.7%. All over expected return of the portfolio, which is what here, somebody? Expected return of the portfolio, expected return of the portfolio, expected return of the portfolio. We had already gotten this expected return of the portfolio. Ilikuwa inakuja ngapi expected return of the portfolio before I go to our pilot paper? Expected return of the portfolio is 11.6 times 100. So could you kindly confirm? 5.7 divided by 11.6 times 100. So this will give us what figure at the end of the day? This will give us what figure at the end of the day? This will give us what figure at the end of the day? 49.14. 49.14%. 49.14%. Now, ladies and gentlemen, the question that I've just done is given here. This is an illustration. This is an illustration. So we have two securities. They have given us returns of each security. They have given us standard deviation of each security. And then they have given us the weights of each security. And then down here, they have given me the covariance. So they wanted us to do two simple things. They wanted us to do two very simple things. Number one, to get expected return of the portfolio. So number one, they want us to give them expected return of the portfolio. And as I explained, a portfolio is an amalgamation. It's a combination of two securities. So we are combining of many securities. We are combining, in this case here, two securities here. So then what we shall do is to take the proportionate returns of each securities forming our portfolio. In as such, expected return of the portfolio then will be equal to what here, somebody? I'll take returns of portfolio 1 plus returns of portfolio 2. This would have been the way to go if we did not have the weights. If we invested in 100% of one and 100% of, but you see, we never invested in 100% of each. So in this case here, we have here weight 1, R1, plus weight 2, R2. So the weights are given, We have here 0.2 times R1, return 1. Return 1 is 10%. I can even leave the percentages. Actually, for portfolio management, always leave the percentages. Always leave out the percentages. So plus weight 2, which is 0.8 times return 2. Return 2 ambayo nimeniambia ngapi hapa ni 12. Nimewacha percentages nje. So could you kindly remind mwalimu the figure? Somebody will tell us here that this expected return of the portfolio, this is expected return of the portfolio is 11 point what here, somebody? Is 11.6. Is 11.6. Is 11.6. Vinik, I'm simply doing this. I'm simply doing this, right? So are we together up to here? 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 Yes. Now from there, number 2, they want us to give them the combined standard deviation, what we call standard deviation of the portfolio. So then how do we get standard deviation of the portfolio? This normally is the biggest formula of portfolio. This is normally the biggest formula in portfolio. So whenever you hear of the aggregated standard deviation of a portfolio, always think about this big square. You may forget about everything, but there is a big square root. It's quite easy. You'll come and talk of standard deviation 1 plus standard deviation 2. But now remember very pretty first that these are supposed to be weighted. So attach the weights. And if you remember, these have to be changed to what? To variances. So you must square both. So plus, ladies and gentlemen, now we come under cough a little bit. We talk of 2 covariance. So we have here plus twice covariance between 1 and 2. And then we have the weights being attached there. So ladies and gentlemen, if this is the case, what we need to do in this case is to come, or we know we are doing this illustration, just come under, plug in figures. We plug in figures. So plugging in figures, what do we have here? We have weight 1. Weight 1 is 0.2 times standard deviation 1, which is 5. Remember, we always ignore the percentages. Plus weight 2, which is 0.8 times standard deviation 2, which is 7. So please remember that everything here is supposed to be done what is squared. Plus twice covariance 1, 2. Fortunately, we were given covariance. Covariance is 0.35. So 0.35, multiply this by weight 1. Weight 1 is 0.2. Multiply this by weight 2, which is what here, somebody? 0.8, which is 0.8. So could you kindly give me the final figure there? So how do you get the final figure? You'll come and take 0.2 square times 5 square, plus 0.8 square times 7 square, plus 2 times 0.35 times 0.2 times 0.8, and then whatever you get, you'll come and say equals, whatever you get, you'll say square root. So square root, what figures do we have here, somebody, after you say square root? What figure do we have here after you say square root? What figure do we have here after you say square root? Please, in the party figures, we don't have time really. Time is not on our side. So I'm waiting for the chart here. So they're telling me, Mwalimu, it is 5.7. So the standard deviation of the portfolio is 5.7. And then now I was going to something very important called the coefficient of what here? So number 3, coefficient of variation. So coefficient of variation, sio mimi nilisema, ni mwanafunzi aliniambia. Mwanafunzi aliniambia, mwalimu, ukitaka nikumbuke CV, formula ya CV, coefficient of variation at in sex in percentage. Sex in percentage like that. So when they want us to give them the CV of portfolio, the CV of the portfolio, then I'll come and pick the standard deviation of the portfolio that you guys have gotten here, which is 5.7. All over X bar is the same as the expected return. X bar is the same as the expected return. Expected return, you guys are giving me a figure of 11.6. So 11.6 times 100. Is there somebody who can give me this percentage very fast? So wanasema ni 49.14. Wanasema ni 49.14%. Thank you very much. Thank you very much. Now, ladies and gentlemen, after that, I would want us straight away to look at number 4. We look at the last one. The last one, number 4, is the return per unit of risk. The last one, number 4, number 4 is the return per unit of risk. Return per unit of risk. How do we get this return per unit of risk? It's very easy. We normally take the expected return, like in this case here, the expected return of the portfolio per risk unit. That is standard what here? Deviation. So all of a standard deviation of the portfolio. Return we expect per unit of risk. Return per unit of risk. So return per unit of risk, return per unit of risk, return per unit of risk, return per unit of risk. We take the return divided by the risk units, which are available there, So basically, the return per unit of risk is the opposite of CV, is the reciprocal of CV. The reciprocal of CV. So simply come and give us, ladies and gentlemen, the expected return, of course, is 11.6. all over the standard deviation, which is 5.7. So could you kindly give me this figure? 2.04. If you want to give it in form of percentage, it'll be 2 or 4%. Either way is correct. Now, ladies and gentlemen, remember that this return per unit of risk is also known as the mean variance. Whenever you've got many portfolios, it will always help you. To pick on the superior portfolio. It is also known as the mean variance dominance principle or rule. The mean variance. So whenever they talk of mean variance dominance, basically they're making reference to the return per unit of risk. Return per unit of risk. AKA inamaanisha also known as. AKA also known as. So kisikia mean variance dominance rule, they want you to calculate the return per unit of what here? Risk. They want you to calculate the return per unit of risk. So I hope that is okay, which now opens a room for us to straight away go to the pilot paper question. Can we go to the pilot paper question? Do we have that pilot paper? Do we have the pilot paper? Do we have the pilot paper ourselves? Do we have the pilot paper ourselves? Here. It's only Mesh who has it. Do we have the pilot paper? Is there anybody who doesn't have it? If you don't have it, you say no. N for no. Well, yes, I'm presuming they have it. If you don't have it, please say N for no. Okay, so it means I project it here. Let me see. Great. So is there anybody who tried this particular question that is given there in the pilot paper? Is there anybody who is saying, ladies and gentlemen, that, you know what, Mwalimu, you don't even have to really do this question. You don't have to do this question. You don't have to do this question because we have already done it. Because we have already done this. Anybody who was able to get this easy question correctly, because it is the easiest question anyway in this pilot paper. Anybody who was able to get it correct? I'm here to see anybody saying yes. I'm here to see anybody saying yes, meaning that all of us, in this case here, so near there. A bird with spectacles. A bird with spectacles. Okay, great, great. So please let me know whether you are able to see my screen. Are you able to see my screen? Are you able to see my screen? Are you able to see my screen? Kindly let me know whether you are able to see my screen. Yes, thank you very much. Great. Great, great. Great. Thank you very much. So we are told here in Roman 2, they want us to use the mean variance dominance rule to evaluate how a card should invest the 10 million. This question is a question of Tom Donji. Tom Donji, I like calling it Tom Donji, but they decided to change the name to a card. A card. So determine the betas and required returns of rates of return for the portfolios, then use the CAPM to evaluate how a card should invest the shillings 10 million. Examine 4 criticisms of Modigliani and the Miller hypothesis without taxes. I may not get A, B, but C, I'll be able to really wrestle around with it. Just like a good wrestler, I'm so sure I can't miss a minimum of 2 marks there. So then what I would want you guys first of all to do, is to take a screenshot of this question. Kindly take a screenshot of this question because I shall not be projecting. I shall not be projecting this question. I shall not be projecting the question. So you're told a card who is my Tom Donji, an investment specialist, has been entrusted with shillings 10 million by a collective investment scheme unit trust, and they instructed to invest the money optimally over a 2-year period. So in this case here, this guy has got how many millions? 10 million maximum. Part of the instructions are the funds be invested in 1 or more of 4 specified projects and the money market. So take in this case here the funds to be invested in 1 or more of 4 specified projects and the money market. Number 2, the 4 projects are not divisible and they cannot be postponed. Number 3, the unit trust requires a return of 24% over the 2 years, right? The following are the details of the investment in the project and the money market. So you're given here project 1, project 2, project 3, money market down there. The correlation has been provided there, ladies and gentlemen. Over the 2-year period, the risk-free rate of return is estimated to be 16%. The market portfolio is 27%, and the variance of the return on the market is 100%. By analyzing 2 assets portfolio, I have to underline this. By analyzing 2 assets portfolios, use the mean variance, I'll be able to get all the marks here without knowing what is expected of me. So, ladies and gentlemen, the first thing that I will do is to consider the pairs. I have to consider the pairs. How do I pair? Because they have told us to use 2 securities at a time to constitute our portfolio. 2 securities at a time to constitute our portfolio. And then, ladies and gentlemen, there is something we have to agree with you because the question is quite lengthy. And of course, you and I are aware that these guys, if they bring a question on portfolio, they can't repeat it exactly like the one that is in the pilot. So you will agree with me that I provide you what we call a high-level solution. A high-level solution, and then I go to things that are relevant. Things that are relevant. Or is there anybody in their wildest imagination? Is there anybody who thinks that CASNEB can bring the actual paper? They take this question like word by word, and then they put it in the actual paper. No, it is great. Never. So it's a high level. Thank you very much. So come and give us the pairs. So hapa kumbuka, it's a straight couple. Mzee na mama moja. So unasema yani unasema kama I can pair P1 and P2. I can pair P1 with P3. I can pair P1 with P4. I can come and pair P1 with money markets. Remember, they have 5 securities. MM stands for money markets. You haven't finished pairing. So from there, come and now take P2. So remember, for P2, it's just like salvation. Forward ever, backward never. So in talk of P2, you can't say P2, P1. So it'll be forward ever. So it'll be P2, P3, right? P2, P4, P2, money market. And then now we start the series of P3. So it'll be P3, P4. And then we have P3, money market. Then we have P4, the last one. P4 with who? With money markets. Thank you very much. Now, the first thing that I will be interested in knowing is the cost. What is the total cost that these pairs will give us? The total cost. I'm interested in the total cost. So if I take P1 and P2, ladies and gentlemen, if I take P1 and P2, how much will this cost me in total? How much will this? Look at P1. P1 is 6, P2 is 4. So 6, 4. So this is 6, this is 4. P1 is 6, P3 is how much? P3 is 6. P3 is 6. P1 is 6. Look at what I'm doing. P1 is 6 and P4 is 6. So I'm simply trying to write these figures here. Like now, P1 is 6 million. P4 is 6 million. I'm just trying to write like that. I'll tell you why. So then the total cost, if I go for P1, P2, it will be 6 plus 4, which gives me 10 million. This will be 6 plus 6, which gives me 12 million. This will be 6 plus 6, which gives me how much here? Somebody 12 million. Now, I would want us to be very clear. What is the cost of P1? Please look at the cost of P1. How much investment do I have to put in P1? How much investment do I have to put in P1? So P1, si umeshaniambia ni 6 jameni. Kila mwanafunzi na P1 ni 6. How about money markets? How about money markets? How about money markets? So money market, ladies and gentlemen, money market. Money market. What is the investment of money market? Investment of money market. Yeah. Investment of money market. 1,000. Mine are in terms of millions. Mine are in terms of millions, but you guys are correct. Because remember, 1 million is minimum. And you are an investment banker who has been given how much? 10 million. And if I realize that I have to pair really then this with the P1, and the P1 is going to take a whole 6, it means that the money market must take what here must take 4 for me to get what somebody there. Because you see, the 1 million there for money market is minimum. I can stretch it because I don't want to be given money and then I stay with some of it being idle. I'm telling you, at times if you get examiners like Mwalimu Mwaura here, you will cry. You will cry. How did we expect even a student to be able to interpret this thing like that? It's very bad. Now, what is the investment of P2? What is the investment of P2? What is the investment of P2? Investment of P2. First of all, help me. What is the investment of P2? P2 investment is 4. That is given, isn't it? P3 investment. P3 investment, P3. P3 investment in ngapi? 6. Thank you very much. P2 now I'll be able to repeat here. P2 is 4. P4 I even know it from here is 6. P2 I know. P2 ni ngapi somebody? P2 ni ngapi? 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 P2 ni 4. Kwa hivyo this time round, nita allocate how much to money market? Nita allocate how much to money market? Given that I've been given 10 million to invest, nita allocate 6. The students were telling me to repeat because I've been given 10. And remember, money market is flexible. It's 1 or more. It's 1 or more. I hope Carol has been able to see now this. Yes. So please, P3 I'll be able to know the investment here. P3 is 6. P4, you guys have just given me 6 there. P3 umeshanipatia tena ni 6. Money market hapa itakula ngapi money market kwa hii scenario? Money market itakula ngapi? Itakula 4. P4 ni ngapi? P4 ni ngapi? 6. Kwa hivyo sasa ya mwisho money market itakula ngapi? Money market itakula 4. Kwa hivyo sasa jameni, ukija hapa, kumbuka these are my portfolios. Don't forget. These are my portfolios. Those are my portfolios. If I'm the one in an exam, I'll put the figures that we have there by the side. I'll put the figures here in, for example, blue. Put them down in blue color, blue pen. So 4 plus 6, that gives me 10. 4 plus 6 gives me 10 again. 4 plus 6 gives me 10. 6 plus 6 gives me 12. 6 plus 4 gives me what? Here, somebody 10. 6 plus 4 gives me 10. Then it means that there are some couples here who are quite expensive. Remember, how much do we have in total for investment? How much do we have in total for investment? We only have 10 million, isn't it? We have 10 million. So inamaanisha kwamba this pair which has got more than 10, which needs more than 10 is not feasible. This one as well is not feasible. This one as well is not feasible. We can't afford it. We can only afford pairs which need exactly 10, 10, 10, 10 like that. Right? Now from there, ladies and gentlemen, I want us to go to the expected returns. Is there anybody who is able to see the expected returns? Are you able to see the expected return of P1? Somebody talk to me. Are you able to see the expected return of P1? Have they given us the return of P1? Have they given us the return of P1? Have they given us the return? They're here. Return over 2 years. P1 return is 22%. P1 return is 22%. P1 return is 22%. Saidini mwalimu nyinyi mko na paper. P1 return umeniambia ni 22. How about P2 return? How about P2 return? How about P2 return? How about P2 return is 26. Now, if you form this portfolio, what do you think will be the expected return? If you form a portfolio of P1 and P2, what do you think will be the expected